Concerns surrounding commercial real estate came into the limelight following the collapse of Silicon Valley Bank and stresses in regional banking. Yahoo Finance had a chance to speak with New York Fed President John Williams exclusively earlier today on what he's been seeing and hearing. Take a listen.
Clearly, commercial real estate, especially office space, there's a lot of open questions about what's going to happen there. With a hybrid model and fully remote work, companies are using office space differently. The demand for office space will be changing. I think that does affect the market price of a lot of those buildings, both here in New York, but in other big cities. So that's clearly something that will have to be resolved over time. It's definitely something very much on my radar, both in terms of the New York City economy, but also broader conditions.
Well, for a deeper dive on all things commercial real estate, let's bring in Hessam Nadji, Marcus and Millichap CEO. Thank you for joining me this morning. So as we heard there from New York Fed Chair Williams there, talking about some of perhaps the risks in commercial real estate. But as we look specifically at some of the sectors within commercial real estate, which ones are raising the biggest red flags at the moment?
Good morning. Thanks for having me on the program. Well, office space clearly is the one that is being watched the most and in a valid way has the most concern around it. In fact, the maturities that are coming due this year are dominated by office properties that were financed 5 to 7 years ago. And the hybrid work environment and the reduced footprint in office buildings is a major concern. I do believe we're seeing the worst of it. I think in the next 2 to 5 years, you're going to see much more return to the office. It won't pre-pandemic levels. I think there is a structural and permanent reduction of office space needs. However, we haven't been overbuilding office space, and therefore on the supply side, we have not overdone it, if you will, as we've seen in past cycles. Nonetheless, in the immediate term, office space certainly will be coming to the market at a time when interest rates are much higher, values are under pressure, and of all the different property types over the past 5 years, office has seen the least amount of rent growth. Therefore, the cushion for office is not quite there as it is for multifamily, for industrial, even for shopping centers, self-storage, and other property types that have seen rent growth. They're in a much better position than office properties.
And we did hear commercial real estate come up from the Fed, earlier from Fed Chair Powell, as we saw interest rates start to rise. But then when you couple that with what we saw with the bank failures, a lot of people wondering about what the sort of fallout that could mean for CRE. But you're saying that this could be perhaps just pose a limited risk to CRE. Walk us through your base case there.
Well, I think the concerns are a little bit overblown in that the headlines are sensational, but if you think about a loan that is coming due in 2023 or 2024 that was issued 5 or 7 years ago, has had time to see operational improvements, has had time to gain values on average, and most importantly, has seen rent growth over the past 5 years. Multifamily rents over the past 5 years are up 37%. Industrial rents over the past 5 years are up almost 50%. So it's not an apples to apples comparison of looking at those loans in today's snapshot of the market environment, recession concerns, higher interest rates, which are significantly pressuring valuations, versus the health of a particular asset and the performance of those loans throughout the last 5 to 7 years. Is there going to be some maturing debt issues? Absolutely. I do believe the number of properties that were financed in the last 3 years on short-term financing, floating rate financing, that are now having issues are going to have a hard time getting refinancing, and therefore they will depend on rescue capital. But there is a lot of capital out in the marketplace, and as values get adjusted according to the current environment, we're going to see a lot of workouts. And to the point that was made earlier by the New York Fed, lenders are much more motivated to work out situations with the current owners as loans mature than to take the assets back or discount them significantly and get them off of their books. So I don't think there would be a major ripple effect. Certainly in the near term, we're going to see cases of a challenging refi environment.
And as we look at the housing market, I mean, there's been some talk of a bursting CRE bubble. Perhaps it would be a sort of slow sort of bursting of a bubble. But what do you think about those comparisons? Because they talk about sectors like skyscrapers and shopping malls being at the cusp of that.
Well, there's certain asset classes that are more exposed. We talked about office. Shopping centers have had some issues in the past. Certainly in the last 10 years, we've seen a revolution really take hold of brick and mortar retail. But retail is on the recovery end of that cycle now, even with e-commerce being a kind of a structural, permanent, factor of life, just like a hybrid workplace is becoming that for office space. We're seeing the renovation and repositioning of shopping centers in a way that's never occurred before. And on the retail side, there's been, for sure, very little new construction. It's been all recycling and reuse of obsolete retail that is now either new retail or some other use entirely. So I think there is a surgical kind of set of areas in the marketplace that are going to have issues, but at a macro level, I don't think we're facing a systemic risk because of the fact that we haven't had overbuilding. Job growth has been very, very strong, which drives the demand for various types of commercial real estate, and different property types are performing, in a very varied fashion, even today.
And so then as you look at how investors plan on re-engaging in this market, talk about how some of this commercial real estate debt is going to be refinanced. Who's really going to be on the hook for that?
Well, you have to remember that the disconnect between the 2008-2009 scenario and the current market environment is the lack of speculation that drove the 2008-2009 crisis. We saw loan to values exceed 80-90% for the 2 or 3 years prior to the 08-09 crash. We did not see anything like that leading into the current environment. We saw a significant amount of speculative construction leading to the 08-09 crisis. We did not see any comparable level of speculative construction leading to where we are today. So those are very different kind of periods of time and had different drivers. As far as who's on the hook, obviously the investors, the equity behind the properties, that have made promises to the lenders, and some of them are recourse, some of them are non-recourse types of loans. But nonetheless, either way, it is in the best interest of the system for these maturing loans and those that are facing significant value reductions, like some of the office buildings that we talked about, get worked out. I do think there will be loan sales. There will be a lot more volume of loan sales. One of the new divisions that our company introduced last year is an auction division that is seeing a lot more demand for that outlet as a way to expedite the marketing of certain assets. So I think the market is going through a recalibration period. The higher interest rates are certainly putting pressure on values. And the Fed really did take out a sledgehammer to the economy and shock the system, unfortunately. Fastest and most aggressive tightening cycle in 40 years is going to have repercussions. We do believe that the banking concerns are going to tighten credit more and slow down the economy in the back half of this year. But we're not expecting a major recession, as most economists are not. And then therefore, we should be able to work through this period. Once the valuation resets, I think the capital is there for investing in commercial real estate.
We'll certainly be keeping an eye on that. I do appreciate you joining us with your insights. Hessam Nadji there, Marcus and Millichap CEO. Thank you for your time.